owner's equity. You need to less the drawings from your owner's equity because of if, as an owner, you might want to buy a car or you might want to go on a holiday and you withdraw that money from the organisation as a form of drawing. So you need to less that because it doesn't come part of your equity because you're taking it out. So your drawings mean you're taking something out of the company that you own. So a particular holiday or any other type, or you might just, it might just be for something simple like stationery. It doesn't have to be big. You might just take out $2,000 or $100, but it still becomes under drawing. So that, what impact do you think that might have on owner's equity?
It will decrease it because the owner's taking in the equity.
Okay, so that's good. Okay, so again, how can we derive owner's equity?
Through the accounting equation, which is assets less liabilities, it owns equity, but you have to also take into account drawings and retained profits and the earnings from the income statement. That all impacts the owner's equity.
And what are assets, an example of assets as well? A bit of a brief explanation, please.
As you said, there's current and non-current assets. So current assets are short-term assets, so around about less than 12 months, which is bank or cash on hand or cash. And it's also accounts receivable because that comes on about 30, 60, 90, 120 days, that sort of thing. And non-current assets are long-term assets that is retained for more than 12 months. So, as you said, it was plant and equipment, machinery, that sort of thing.
What's the importance of the reports? So having income statement and a balance sheet, obviously they're reports, but what are the benefits of them?
Because companies want to know how well they're doing. They want to see what they have today as their balance sheet, and also what they have earned throughout a period as well, usually a financial year. And they report that to shareholders as well, like it's in annual reports and stuff. And all given to the directors to make important financial decisions.
And what specifically within the reports do you think they look at? Do they just look at the whole thing? Specifically, they might look at the income?
Specifically, I think the
depends on their purposes.
I think the bottom line is they'll be looking at the net profit first and foremost. Yeah. And then they'll also be looking at the sales and reflecting on the expenses as well.
How they can try to minimise expenses as much as possible and try how they can increase.
And they want to have a look at the balance sheet because they want to make sure that their liabilities haven't exceeded their assets.
Yeah. Okay, good. So what is benchmarking? Do you have a bit of understanding what benchmarking is all about?
A little bit. I think it's about when you compare ratios with industry standards, then that would be benchmarking.
Yep, so from these reports, obviously you can conduct ratios. So from the reports help you to, calculate the ratios. But benchmarking is comparison, so it's comparing from one period to another.
In that way, yes. Yeah,
so
comparing
periods. Any report, so comparing, this report to the other financial period and seeing whether you've, got a profit or whether you've got a loss. And you have to explain to shareholders if you've got a loss, why you've got a loss. Or as well, otherwise they'll be very happy if you've got a profit. So what do you think are the main things? Do you think they're important, the balance sheet and the income statement? Do we need them?
Oh, of course. It's just a way of measurement to see how we're actually doing, how we're performing, that sort of thing.
Okay, good, yeah. So do you get the idea of what the relationship is between the income statement and balance sheet?
Yeah, I have more of a knowledge now as well. Yeah.
Okay, so that's good. Again, how would we calculate expenses?
That's a tough question. I would just add all the expenses. Like, for example, like other expenses are like insurance, insurance, rental expenses, depreciation, delivery charges, that sort of thing. So you just have to add them all up.
Okay. Obviously, when you have the reports, obviously you need to have a title for both of them. Pretend you have your own company, like Pamela's Corporation. What would you write in the heading on top of the balance sheet?
We have to actually write the actual names. For the balance sheet, it's a statement of financial position, and while the revenue statement is actually the statement of financial performance, and that's under the accounting standards as well.
Okay. Specifically, what I was trying to get to was, as I said before, so for the income statement or revenue statement, you go, okay, for the period 4. Whereas income balance sheet is
okay, yeah,
the title, the actual title.
For the balance sheet is as at,
Yep.
and at a particular point in time, while the revenue statement is for the year ending 30th of June 2010 or a different reporting period.
Yep. So it
I
could
think
be,
like in New Zealand, the reporting period is from the 1st of April to the 31st of March. In America, their financial year ends at the 31st of December.
Yep. Okay.
And while in Australia, it's the 30th of June.
Yeah, so that's good. Yeah, but it can also be monthly or again quarterly. Depends
absolutely.
on when the reporting period comes.
Yeah, definitely.
Yep. Okay. So why would they say a balance sheet is a snapshot?
Because at that particular point in time, it's as at that date, all the assets and the liabilities value at that date.
Yep. And again, okay, so we've seen the similarities and how they're similar in the relationship between the income statement and balance sheet, but do you have any idea what sort of, there might be any differences between the balance sheet and income statement?
There's heaps of differences. They're quite different. While the balance sheet looks at the assets, liabilities, and its equity, while the income statement looks at the income, like revenue, sales, and less expenses. And then they interconnect because of the profit and loss goes into the balance sheet under the earnings equity part.
Yeah, okay, so that's cool. And it does come difference because of the debits and the credits, because when we have assets, it's regarded to be as a debit, and liabilities are credits, and your income is also credit as well, and your expenses are debits. So it's opposite.
Yeah.
In regard, so you just have to split it to it. So if you write a journal entry, if your assets increase, then generally your bank liabilities increase as well. So any questions that you might have in particular in today's session between the income statement and balance sheet? So again, just to summarise what I have been saying, your income statement looks at the difference between, your revenue and your expenses, and the balance sheet looks at your assets, including your current assets, your non-current assets, your liabilities, your current liabilities, non-current liabilities, and also your owner's equity, which encompasses your retained earnings and also your drawings, and depreciation, which is incorporated into your balance sheet and also income statement, because of the value of assets obviously decrease over time. And the relationship is the earnings. So what the business earns, the income, is the relationship, because whatever you earn into the income statement, so the net income goes straight into your balance sheet. And that's pretty much that we looked at today. And why people should report, because for shareholders and to track how they're going, so to benchmark. Do you have any questions that you might want to ask for this today's session?
I think that all covers it. Basically, yeah. So you've answered my questions that I had questions before.